Welcome to our today's training. So in our today's lesson or course, we are going to look at leverage and margin. Leverage and margin. How can you use them in the forex trading? Okay. How can you use it in the forex trading? My name is Lee Mashebe. I'm your today's instructor or mentor. I'm the one that is going to take you in this course. So remember, this course, it is brought you by ReFX Academy. Now, as we continue, always remember that there are two things that a trader needs to know about how to forex works before they start trading. And these two things, they are very important. These are leverage and margin. Leverage and margin. So this is what we are going to discuss. Now, what is leverage in forex? So leverage, this is in a short term, it is borrowed capital. Okay, it is a sum of money that your broker provides to you, so that you could have greater flexibility when trading on the forex. As we know that the forex market, it is large, okay, it is huge, very huge. In our previous lesson, we discovered that in a long time ago, it was only big companies which were involved into trading. So now, because of forex brokers, you and me today, we are able to participate in the forex. Reason why? Because of the same leverage which the broker gives us. Okay, so it simply means leverage allows you to trade larger lots and open more position without putting all of your equity into one huge trade. Okay, so this is what you need to understand. So this is all about the leverage in forex. Now let us look at the example of leverage. Okay, so here an example, it will help you on your way. What else you are trying to sharpen your skill. So let us give an example. Suppose you decide to use the 1 to 100 trading leverage. I'm sure you have been seeing those different kind of leverage. So let us just give an example, 1 to 100 trading leverage. What does it mean? Simply means that out of 100% of your money, you provide only 1%, while your broker provides the other 99%. Okay? Let us continue so that it makes more sense what we are talking about. So it simply means that when trading on forex, you are trading lots. Okay, you probably know that when trading on forex, you are trading lots. So those lots, that is what you are trading. So one lot usually is equals to, or it is 100,000 units in the base currency of the trade. So the minimum trading volume usually equals to 0.01 lots, or we can say 1,000, okay, units of the basic currency. So if you are buying Euro SD, the minimum purchase that you need, it is $1,000, okay, which we know it can be a lot for a trader, okay, a lot for a trader, and they can open only one position with this amount. Can you imagine? Just to open one position with this amount. So this is the amount of money that we are supposed to open just within one single trade, which is equals to $1,000, and you only required to open one position. Okay. However, if a trader is using 1 to 100 leverage, they need to provide 1% or $10. So the broker will provide the remaining, which is $990. Okay. Still, the profit or the loss will be calculated on the leverage amount or sum. Okay. Very important. Very important. So it is always important that you get to understand that the change in currency value is measured in points, okay, which is depending on the currency, okay, which depends on the currency. So which depends on the currency. On the currency, we can talk about liquidity. Okay, so different pairs can have different points. Okay, so we can give an example with Euro USD. 1 point equals to 0.00001. Okay. So now suppose the major financial event affects the USD price, and because of that it declines by 500 points. So if a trader purchased 0.01 lots of EURUSD, which is $1,000, their profit will be equal to the position lots, which is 0.01. So when you multiply by the number of points, 500, the profit on the trade will be $5 or 0.5%. Okay, which you can do which we 0.5%, open bracket, 0.01 by 500, which gives us 5. Okay. Now, if a trader has no leverage, what will happen is that once they need to put in 1,000 in the trade and profit of $5 or 0.5%. If a trader uses the leverage of 1 to 100 leverage and they do the same trade, their own investment will be only $10. Okay, but the profit will stay $5, making it a 50% profit. At the same time, using all your leverage, which is 1 to 100, and opening the all lots of one lot trade could result into 500 wave of profit. Okay, so this is how leverage works. So forex brokers offer the wide, as you can see, wide range of leverage sizes, as we are going to discover. So which has got its own different rules. So for example, let us look at this broker, which is called FBS, which offers 1 to 50, 1 to 100, 1 to 200, 1 to 500, 1 to 1,000, 1 to 2,000, and 1 to 3,000 leverages. So it simply means that at FBS, this broker, the leverage it differs with accounts. So depending on which account that you open. So they can also give you access through there. When you go to your personal area, you can also change the account settings. You can put each leverage that you want. Okay, so you need to choose leverage that is most suitable with your skills. Okay, so now let us also look at the risk of leverage. So leverage increases. It increases how the market moves. Okay, how the volatility, how it is. So what we need to understand is that your leverage can earn more with the same amount of money. However, you can also lose more. So using your leverage, you can make more money. You can also lose more too. Okay. So let us use this example. The leverage of 1 to 100. You may open a $10,000 trade having only $100 on your account. Okay, just having $100 on account by using the 1 to 100 leverage, you can open a trade of 10,000. Okay, so if the trade moves 1% in your direction, you get $100 of profit. Okay, again, if it goes opposite your direction, you lose the same $100. Okay, now let us move to what is margin in Forex. Now, since we have already understood leverage, the margin, it is easy to understand. Okay, so in Forex trading, the margin is a sum of money that is required to open a position. So for you to open a position, there's the leverage, there's a margin which is needed. Okay, so for you to open that particular trade. So in this example that you have seen here, so you discover that the $111.50 is the margin a trader provides in case of using the 1 to 100 leverage. 1 to 100 leverage. So it is very important that you get to understand that. So the funds you hold in your trading account are the money you use as a margin when trading on Forex. Okay, so if you expect to get some profit, all what you need to do is that you can use a large leverage ratio, okay, and the smaller margin to control the bigger trade size. This is very important. So margin requirements. So your trading platform should show you free margin, okay, free margin, which is the usable margin. Okay, we can also talk about margin level figures. Okay, so now what is a free margin? A free margin is the money in your account that can be used to maintain your open position or to open new position. So you depend on your free margin for opening more position or to maintain your position. Once your free margin is it is done, it simply means that you can't continue trading. So the margin level is the percent that shows the trader how much of their funds is not being used at the moment. Okay, at the moment. So that is the margin level. So the margin level, it is the percent that shows a trader how much of their funds is not being used at the moment. So margin level depends on the leverage ratio that a trader chooses. Okay, so it is very important that you consider that. So this is very important to consider that. So for example, the lot size, let's say the 2000, it simply means only 2% of margin which is required. So let's say $1,000, only 1% is required. $500, only 0.5% which is required. Okay, if you are using the 1 to 100. Okay, so for forex margin requirement depends on the margin level that a trader chooses, as well as the lot size and the instrument. So this is very important. So now let us look at margin call. So when you are trading, when you lose, when you are losing, you remember there's that. If you have noticed, there's that message that the broker sends to say you're losing, then they'll cut your trade. So it is what we call the margin call. So if one of your open position is losing one, your margin level will be going down. Okay, your margin level will be going down. Why? To avoid losing all of the money. Brokers use the so-called margin call. A margin call is specific margin level We can give an example with this broker called FBS. It requires 40%. What does it mean? It simply means that once it reached by a trader, a warning actually it comes to make sure that a trader can either crosses the trades or deposit more funds into the amount. So it gives you an option: either you cross or you deposit more. But if you fail to follow those instructions, they will cut you from the market. Stop out level. So once the margin level drops to the minimum allowed level or stop out level, in this broker FBS, which is 20%. Some trades starting with the most losing ones will be crossed automatically to prevent a trader negative balance. So do not be surprised once you are cut from the market. So equity, margin level, and free margin change in real time. So pay close attention to those numbers, especially if you use the large margin ratio. Okay, I mean leverage ratio. So leverage can lead to big profit with smaller investment. Just with a $10 you can make good profit. With a $100 you can make good profit. So still the same formula applies to loss. So be careful when you are deciding on leverage. So make sure that your profit, be sure that your profit will multiply, but in case of a loss, they will also multiply. That is the advantage. That is also disadvantage. So margin and the leverage. The difference. What is the difference between margin and the leverage? So leverage in Forex, it is a broad capital that allows you to increase your trading volume and the potential returns. It is a sum of money brokers lend to traders to have greater flexibility when trading on the Forex. So that is the leverage. Okay. Now when it comes to margin, so on the other hand, the sum of money required for traders to open a position. So for you to open a position, there is a sum of amount of money which is required in order for you to open that specific position. So the funds held in a trader's account are the money used as a margin. Okay, so it is needed to cover the potential losses that may occur during trading. So the margin requirement depends on the leverage ratio. So you can talk about the lot size, the instruments that you are trading. Is it PUM 1000? Is it Crash 1000? Or other currency pairs that you can think of, which can be used in the trader's account. Okay, so both leverage and margin are very important. Leverage gives you more power in your trades, and the margin protects your balance from going below zero. So use this knowledge to succeed in the good luck. So this is where we end in this course. So I hope you have benefited. I hope you have enjoyed. If you have not yet, if you have not yet gotten everything, you can still go through the course over and over until you understand. This is where we end. God bless, and let us meet in our next course. Bye-bye.